Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, August 22nd at 11 a.m. in New York, so let's get after it. Taking a few weeks off can sometimes provide a fresh perspective on markets needed at times like today. The fact that it happens to be August, the most popular time for vacations of the year, can also play into that perspective. Over the past 6 weeks, many financial markets have had a strong rebound. As an example, both stocks and bonds have rallied sharply from their June lows. The question that equity investors must ask themselves is how much of the rally in stocks is due to the fall in interest rates versus a real improvement in the prospects of a soft landing in the economy. For better or worse, our view has remained consistent since April that the primary concern for stocks was no longer inflation or the Fed's reaction to deal with it, but rather the outlook for growth. In May, the consensus moved strongly into our camp, with the cries for a recession reaching a fevered pitch in June. Equity markets became very oversold, and the stage was set for a powerful rally. Truth be told, this rally exceeded our expectations for a normal counter-trend bear market rally. However, in order to set the stage for the next leg lower, the rally needed to be convincing enough to change the very bearish sentiment to outright bullish. Based on what I've seen in the press and from our peers around the street, that sentiment has flipped, with many declaring the end of the bear market and the increasing likelihood of new all-time highs as soon as later this year. While there are some strong indications that inflation has peaked from a rate of change standpoint, it's too soon for the Fed to declare victory in our view. In other words, the rising hope for the Fed to pivot away from rising rates or curtailing its balance sheet reduction remains optimistic. Nevertheless, this is the primary justification for why equity markets have rallied and why it can continue. However, even if that were true, there are very few data points suggesting we have reached a trough in growth, either economically or from an earnings growth standpoint. In fact, our growth is suggesting the opposite, with earnings revision breadth accelerating to the downside, along with our other leading indicators. To put it more bluntly, rarely have we been more confident that consensus growth expectations for earnings over the next 12 months are too high. More importantly, the equity market almost never rallies if forward earnings estimates are falling, unless the valuation is completely washed out. In June, one could have credibly argued valuations were discounting a sharp decline in growth and the risk of a recession. At the lows, the forward price earnings ratio reached 15.4 times and was down almost 30% from the end of last year. That 15.4 times was almost exactly our year-end target price earnings multiple at the beginning of this year, based on our view that the Fed would have to tighten aggressively to combat inflation. The problem with assuming 15.4 times was a washed-out level for valuations is that all of the degradation was a result of higher interest rates, while the equity risk premium remained flat to down over that time frame. In other words, at no time did the price earnings multiple discount a material slowdown in growth. Now, with the price earnings multiple exceeding 18 times last week, valuations are inappropriate if one agrees with our view that earnings estimates are too high. On Friday, stocks reversed lower, and that seems to be carrying into this week. Many are once again blaming the Fed and perhaps acknowledging its work in fighting inflation remains unfinished. We agree. However, with price earnings multiples still 17.4 times as I record this podcast, valuations are not discounting that resolve, nor is it discounting the negative earnings revisions still to come. The bottom line, stocks have experienced a classic bear market rebound after having reached a near-record oversold condition on many metrics. With the Fed still very much in the picture and earnings estimates likely to fall further, equity markets are almost as unattractive as they were at the beginning of the year. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.